How coordination solved one crisis while seeding another. Coordination saved Europe's banking system. Shared action stopped panic. Unified responses restored confidence. Togetherness became the solution. But coordination has a hidden side. To understand why it still matters today, we need to examine what coordination changes. Because acting together solves immediate problems, yet it can quietly reshape future risks. When crisis struck, fragmentation was dangerous. Unilateral moves spread fear. Inconsistent rules amplified uncertainty. Markets punished division instantly. Europe responded with alignment. Central banks synchronized actions. Supervisors shared information. Governments coordinated support. This unity worked. Signals were clear. Markets stabilized. Confidence returned faster than expected. Coordination became the blueprint. Every major stress event triggered joint response. Frameworks deepened. Institutions aligned processes. Banks adapted to this environment. They planned for collective action. They assumed shared solutions. They treated coordination as a constant. This reduced uncertainty. Policy responses became predictable. Markets learned the pattern. Risk felt manageable again. But predictability has consequences. When responses are known, behavior adjusts in advance. Strategies adapt to expected coordination. As coordination deepened, autonomy narrowed. Decisions increasingly relied on consensus. Speed depended on alignment. Divergence became costly. This influenced incentives. Institutions delayed action, expecting collective moves. Markets waited for joint signals. The system became efficient at crisis response, but less flexible in anticipation. Local judgment gave way to shared timing. Banks responded to this rhythm. They synchronized strategies. They aligned exposures. They reduced activities that diverged from collective norms. This reduced fragmentation, but it also reduced variation. Risk profiles converged. Behavior standardized. When small shocks appeared, coordination absorbed them smoothly. But when larger stresses emerged, responses overlapped. Pressure intensified everywhere at once. Authorities faced a new constraint. Acting alone risked undermining unity. Acting together required agreement. Timing became delicate. Markets watched for hesitation. Delays amplified uncertainty. Unity reassured, but hesitation unsettled. The system relied increasingly on trust in coordination itself. Confidence shifted from institutions to process. Coordination had become infrastructure. It stabilized flows, but it also synchronized reactions. And synchronized systems behave differently under stress. They move together, for better and for worse. The conflict emerged when coordination itself became constrained, because unity requires agreement, and agreement takes time. As stress intensified, differences surfaced. National priorities diverged. Political pressures varied. What looked unified and calm revealed friction under strain. Authorities weighed trade-offs carefully. Move fast and risk uneven outcomes. Wait for alignment and risk delay. Every option carried systemic implications. Banks felt this hesitation immediately. Markets paused. Liquidity tightened. Confidence became conditional on timing. Coordination, once reassuring, now slowed reaction speed. Signals blurred. Expectations wavered. This exposed a fragile balance. Too much independence fragments markets. Too much coordination synchronizes stress. The system struggled to find middle ground. Local flexibility was limited. Central action required consensus. Adaptation became procedural. Markets reacted to uncertainty. Volatility returned in waves. Risk perception shifted rapidly. Trust leaned on belief in eventual alignment. The crisis was managed, but the experience left a mark. Coordination had solved panic, yet it had also revealed rigidity. What was once a strength had become a source of vulnerability, not because coordination failed, but because it could not move selectively. The system had learned to act together. It had not learned how to let parts act alone. The climax arrived with a sobering realization. Coordination is powerful, but it is not neutral. Europe learned that acting together can stop panic faster than any single institution. It can restore confidence. It can stabilize a system on the edge. But coordination also reshapes incentives. It teaches markets what to expect. It teaches banks how responses will unfold. And expectation changes behavior long before crises arrive. The system adapted. Joint action became embedded. Processes were formalized. Alignment was treated as resilience. Yet resilience requires contrast. It needs room for variation. It needs the ability to isolate stress, not just absorb it collectively. Europe's banking framework now reflects this tension. Deep coordination remains essential, but flexibility is slowly reintroduced. Local judgment is cautiously reclaimed. The lesson was not that coordination was a mistake. It was that coordination, without optionality, creates its own form of fragility. A system that only moves together cannot choose where to bend. It bends everywhere at once. Understanding this matters now, because the next crisis will not reward uniform reactions. It will test whether Europe can combine unity with selective action. Sometimes the smallest shift in perspective becomes the beginning of a new future. The hidden cost of deep coordination is something that only becomes visible when the coordination is tested by something it was not designed for. Europe's coordination infrastructure was built to manage known types of stress: liquidity withdrawals, sovereign spread widening, bank funding pressures, cross-border contagion of a familiar kind. For these scenarios, the coordination frameworks developed across the crisis years were genuinely effective. Information was shared more quickly, responses were aligned more rapidly, confidence was restored with less delay. But coordination optimized for known stresses has a structural limitation. It teaches participants to expect coordinated responses, and it teaches them to wait for those responses before acting independently. That wait is rational when coordination will arrive. It becomes problematic when the stress is of a type that coordination cannot address, or when the coordination is delayed by the novelty of the situation, or when the speed of the shock exceeds the speed of the coordination process. In those cases, the waiting behavior that coordination has taught becomes a source of additional fragility, because participants who would otherwise have acted independently are instead waiting for a coordination signal that may not come, or may not come quickly enough. This is not a theoretical risk. It is the pattern that tends to emerge when any system optimizes for one type of response, and then faces a situation that is qualitatively different. The system freezes momentarily, not because its participants are incompetent, but because the trained response is inapplicable, and the untrained response requires independent judgment, which coordination has partially atrophied. Europe's banking system has not faced this test in its fully developed coordinated form. The crises it has experienced since deepening its coordination infrastructure have been of types that the infrastructure was designed for. That is reassuring. It is also potentially misleading, because a system that has only been tested by familiar stresses cannot confirm that it is resilient to unfamiliar ones, only that it has been resilient so far, which is a different claim. The structural challenge for European banking coordination going forward is to preserve the genuine benefits that coordination delivers, while rebuilding enough capacity for independent judgment and selective action, that the system can respond effectively to stresses that fall outside the coordinated playbook, that requires accepting some of the fragmentation and inefficiency that coordination was designed to eliminate. Not all of it, but enough to preserve the diversity of response that monocultures, however efficient, cannot provide. That is a genuinely difficult balance. It cannot be achieved through a regulation or a framework. It requires cultivating a culture within institutions that values independent judgment alongside coordinated action, and a governance structure that creates space for both, without treating the capacity for one as evidence of failure in the other. Europe is not there yet. It is closer than it was, and the recognition that coordination has costs as well as benefits is the beginning of designing for both. Sometimes the smallest shift in perspective becomes the beginning of a new future, not as an abstract goal, as a specific, practical commitment to ensuring that the system can act selectively as well as collectively, partially as well as uniformly, quickly in isolation when isolation is appropriate, Slowly and together when togetherness is what the situation demands. The wisdom to know the difference is not written into any framework. It lives in judgment. And judgment, in systems as large and complex as European banking, must be cultivated deliberately or will atrophy, as it partially did, in the long years of building coordination. At the cost of the independence, it was partly replacing. How